Welcome, everyone. To start, you want to encourage everyone to read these books and form your own opinions. But if you think you can just blindly follow the teachings in America's top selling investment books, you will be terribly disappointed. None of these books would have helped you avoid the market's disaster meltdown this year. Here are the least understood problems with America's investment bestsellers. Number one is The Intelligent Investor by Benjamin Graham. This is a book that aims to help people invest in the stock market while minimizing their economic risks. It focuses on longer-term and more risk-averse approaches. Graham focuses on investments, which are based on research, rather than speculations, which are based on predictions. There seems to be a gaping hole in this narrative, which is what exactly causes undervalued securities to reach their full value. This book is now outdated because it fails to show how old-school value investing strategies have been overtaken by activist investing. A cheap stock can stay cheap without a capitalist. Activist hedge funds such as Dan Loeb's Third Point Capital and Bill Ackman's Pershing Square Management have a combined hundreds of billions of assets under management dedicated to actively encouraging companies to close the gap between their share price and intrinsic value through strategies such as share buybacks, corporate restructurings, and M&A activity. If you don't team up with the right activist, your treasure could remain buried forever. Before we keep going, it would be a huge help if you hit the like button and the subscribe button for the YouTube algorithm. Thank you so much. Number two is The Millionaire Next Door. This book identifies 7 common traits that show up again and again among those who have accumulated wealth. Our question is, don't you need different strategies to succeed when the economic conditions around you are different? If you are a millennial today, you are facing problems that the millionaires next door did not have to grapple with, such as high student debt, stagnant wage growth, unaffordable housing, and frequent market crashes. Being frugal will always have its place, but people need a way to grow through a variety of economic cycles, rather than a prescription for economic circumstances that may never be repeated. Number 3 is Morgan Housel's Psychology of Money. The summary is that in this book, he shows his approach to money using a series of short stories across 18 chapters. Our question is the following. How are you so confident about low cost and excellence? Surveys show that wealthy investors hold 25 to 55% of their wealth in stocks and stock funds. How do these investors sleep at night when their funds are down more than 20% in just a few months? Our answer is that these investors sleep at night because broad stock indices are a poor foundation of our financial system, and global central banks have either directly bought ETFs or bought similar assets to help restore these assets to their baseline trend performance. Investors are confident that governments will eventually provide stimulus to restore trend growth in the broad stock market. This support system does not exist for crypto or private equity or art or other luxury collectibles. It also does not exist for individual stocks. The government cannot care less if Disney stock is down 50% this year. But if the US pension system defaults because the entire stock market index is down 50%, then it will have to spring into action, provide stimulus, and rescue the system. Number 4 is Rich Dad Poor Dad by Robert Kiyosaki. The overarching theme of this one is how to use money as a tool for wealth development. It destroys the myth that the rich are born rich, explains why a personal residence may not really be an asset, and describes the real difference between an asset and a liability, and much more. Our question is, how are you supposed to accumulate income-generating assets if you don't have any cash or assets to start with? For most people, getting a professional degree in law, accounting, or medicine, or getting an MBA or PhD is still a great low-risk way to generate a good base of income. You could take advantage of cheap government-subsidized student loans and have low monthly payments relative to your income. The average salary of a Stanford MBA is $191,000, and the annual cost of your student loan is likely less than $20,000. It is silly to convince people who have natural aptitude and could easily be in an Ivy League MBA program to become an affiliate marketer instead. Number 5 is The Total Money Makeover by Dave Ramsey. This book has a program for getting and staying out of debt to improve your financial well-being. The question is, if all debt is bad, how do you explain how wealthy corporations and individuals use debt to enhance their financial well-being? This book stops short of explaining how debt can effectively and safely be put to work to enhance your wealth. Most people agree on using a simple rule of thumb. If you use low-cost debt to buy appreciating and income-generating assets, it can help you grow your wealth. On the other hand, borrowing just to pay ongoing living expenses or purchase luxury items is not a good use of debt. If Ramsey can actually help people achieve 12% returns in the stock market, as he claims, it would be foolish to take money out of the market to pay down a mortgage that only has a single-digit interest rate. Number 6 is the book on rental property investing. Author Brandon Turner discusses the strategies he used to build his own wealth in real estate, including how to find, analyze, and finance attractive rental properties. Our question is, how do you deal with factors such as high interest rates, housing supply shortages, and labor shortages? The time period from the last financial crisis in 2008 through the end of the pandemic in 2021 was one of the best times to own and operate residential properties in the US. It was so good that the largest, smartest institutional asset managers in the world, such as Blackstone, decided to devote billions of dollars to this strategy. However, with high mortgage rates now and shortages of labor and materials driving higher costs, people need new, different strategies to continue to make money in rental real estate. Number 7 is principles. Ray Dalio, founder of one of the largest hedge funds in the world, Bridgewater Associates, discusses his unique philosophy that life, management, economics, and investing can all be systematized into rules and understood like machines. The question is, what is the link between Dalio's principles and the investment returns at Bridgewater? Dalio measures the success of his principles by the amount of assets his firm manages, which is well over $100 billion, rather than the performance of his strategies. He should separate between using the principles to manage a large organization versus using them to generate strong investment returns. In order to manage a large amount of money, you need to attract money from large allocators, like sovereign wealth funds and pension funds. Those institutions want to invest in professionally managed organizations, not firms run by cowboys. The principles are a persuasive shell of professional management. However, when it comes to measuring performance, Bridgewater wasn't even in the top 50 hedge funds, based on their trailing 5-year net returns as of 2021. The number 1 spot belongs to a 34-year-old Harvard MBA named Jamie Stern, who runs Sky Global, which itself is modeled after funds like Third Point and Tiger, not Bridgewater. Number 8 is The Simple Path to Wealth by Giles Collins. This is financial advice based on the author's letters to his daughter. The question is, why aren't there any simple ways to hedge against declining stock market returns? Why should you believe that the stock market will always go up in the future? What if stocks are overvalued and stay flat or down for decades? This is another book that points to the historical returns in the stock market and recommends using ETFs to capture the average stock market return. There's no backup plan for the case where stock market returns are flat or negative, during a large portion of your lifetime. Sophisticated investors look for market-neutral or anti-fragile investments, those that will perform regardless of whether there is a bull or a bear market. Timing the market is complicated, but there are other simple ways to hedge against market declines, and those need to be taught. This includes our video. Please like and subscribe, and tune in for the next one.